Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. So, you need experience to get the job, but you need the job to get experience. That's a classic catch-22. You've probably heard that term before. It comes from Joseph Heller's classic novel, Catch-22. And it's basically a paradoxical situation where an individual can't avoid a problem because of contradictory constraints or rules. So in the novel, pilots who were mentally unfit to fly could be grounded. But if they requested to be grounded to avoid dangerous missions, well, it demonstrated their sanity, making them fit to fly. Thus, they were trapped in an illogical loop, a catch-22. You know who's in a catch-22? Powell and Company over at the Federal Reserve. You see, the Fed has two overreaching mandates. The first is to maintain price stability. Now, they don't exactly define that term in the same way a normal person would. Like, I would say price stability means the overall price level isn't going up or down in any significant way. However, in Fed speak, price stability means prices are going steadily upward at a 2% rate. I mean, I guess they could argue the stability is in the rate of increase. It's stably going upward. But what I'm really driving at here is price inflation isn't a bug as far as the central bank is concerned. It's a feature. It's on purpose. They want inflation, but they don't want prices going up so fast that you happen to notice. So anyway, that's the first mandate. The second mandate is maintaining maximum employment. So if you kind of put it all together, the Federal Reserve is supposed to, as far as it depends on their monetary policy, keep the economy growing and keep price inflation under control. So with that in mind, think about the situation that we are currently in today. The central bank needs to keep cutting interest rates because a debt-riddled economy addicted to easy money can't function in this higher interest rate environment. And if you listen regularly, you know I talk about this a lot on the show. The Fed broke the economy a long time ago when it held interest rates artificially low for nearly a decade after the 2008 financial crisis. And then it doubled down with the easy money during the pandemic. We're not just talking about interest rates at zero. We're talking about quantitative easing, which is in effect money printing. And that has consequences that really haven't manifested yet. But it did manifest in price inflation. After trying to pretend it was transitory, the Fed finally got to work and rose interest rates at a historically fast pace. So after incentivizing the debt binge with 0% interest rates, the central bankers basically said, sorry, now you have to pay for all of this. And, I honestly think a lot of people in the mainstream had come to expect the easy money party would last forever. I mean, think about it for a minute. This has been going on since at least 2008. So you've got a lot of people who are now in the investment world who don't remember really anything close to what would have been normal interest rates, 30 or 40 years ago. So surprise, right? The Fed took away the punch bowl, and now they need to give it back if they want to take care of that second mandate, which is maintaining employment, which is really shorthand for keeping the economy afloat. And some cynical people might argue also to keep the stock market going up. So they think they might be able to keep the whole house of cards from falling down by holding interest rates a little bit higher for a little bit longer. But I think it's too late, right? However, the mainstream really still believes this whole soft landing narrative. Now, on the other side of the coin, the Fed needs to keep interest rates higher to keep inflation at bay. And I would argue that they really need to crank them higher than they are now, given the reality of the inflation situation. And it's kind of interesting. I saw a chart the other day, and it charted the trajectory of price inflation based on the CPI back in the 1970s. And then it overlaid the trajectory so far of price inflation since the pandemic. And if you look at this chart, you'll see that that price inflation peaked in 1974 at around 12%. And then if you go and you look at the trajectory of interest rates, the Federal Reserve pushed them up in late 1973 and into 1974. So the interest rate actually peaked at 13% in the summer of 74, and price inflation came down. By early 1976, they had cut interest rates back to 4.75% because they basically declared victory over inflation. Well, guess what? In 1977, the CPI peaked again, and by January 1980, it was nearly 15%. And of course, that forced Paul Volcker to actually go to war with inflation. He jacked interest rates all the way up to 20%, and he finally laid the inflation dragon to rest. So if you look at the trajectory of the CPI between 2022 and today, it tracks almost perfectly with the mid-1970s. You see it going up, up, up. You see interest rates going up, and then price inflation cooling off. So the thing about it is, as was the case in the mid-1970s, yes, CPI came down, but it never got back to that target, to the mythical 2%, before they started declaring victory and cutting interest rates. So the most recent inflation data has shown if it's not heating up, it's at least showing signs of stickiness. So really what I'm getting at, and I'll post a photo of this chart on the show notes page over at moneymetals.com/news if you want to look at it. But what I'm really getting at here is that, there are signs that we're really following the trajectory of the 1970s, where we had price inflation, the Fed raised rates a little bit, declared victory, cut rates, and saw CPI spike again, even higher than it had originally. Is that pattern about to repeat? Well, I don't have a crystal ball, but they do say that even though history doesn't necessarily repeat, it often rhymes. And I think given the amount of inflation, the amount of money that has been injected into the economy since 2008, nearly $9 trillion just in quantitative easing, on top of all of the stimulus created by the artificially low interest rates, I think it's fair to argue there still might be enough inflation floating around out there to keep prices moving upward. But the real point that I'm driving at here is that when you look at these two mandates and you look at what's going on, the Fed is really stuck between a rock and a hard place. What does it choose? Does it continue to battle price inflation, keep interest rates higher, risk crashing the economy, creating a financial crisis, popping the debt bubble? Or does it go ahead and continue on the path that it's chosen, cutting interest rates, right? But risking the rekindling of price inflation? So, I can't really predict what the Fed is going to do. I think they're going to try to walk the tightrope. I think they're going to try to play both sides of this coin. And, you walk on a tightrope long enough, you lose balance and fall off. So anyway, there were some recent comments by Donald Trump that kind of illustrates the position that the Fed finds itself in. It kind of highlights this catch-22 situation. Because, Trump hasn't even been sworn into office yet, and he's already locking horns with Federal Reserve Chairman Jerome Powell. So during the December Fed meeting, you will probably recall that Powell and company indicated that the pace of rate cuts is going to need to move more slowly than initially projected. But Trump is saying we need lower interest rates now. And there's that catch-22. Right? You can't have lower interest rates and higher interest rates at the same time. It's impossible. So let's look at these two positions and kind of juxtapose them. Let's take Jerome Powell's position first. So the Federal Reserve, in effect, declared victory over inflation, and it began easing monetary policy in September with a supersized 50 basis point rate cut. Now, the fact that they chose to go big on that first cut, or at least relatively big, 50 basis points instead of 25 basis points, that indicates to me that the central bankers really were, even though they're never going to say it out loud, they were worried about the impact of these higher interest rates on the massive amount of debt that is in the economy. You've got government debt, you've got consumer debt, you've got corporate debt, all at record levels. With interest rates going up, it's becoming more and more difficult to service all of that debt. The Fed knows that. Now, they're not going to say, oh, look, we created this problem. They're going to try to fix it without you knowing they did it. They're like the little kid that knocks over the cookie jar and it breaks into a million pieces, and the kid didn't, he glues it together and puts it back up there, hoping mom and dad don't notice. That's kind of how the Federal Reserve does things. They create these inflation problems, and then they blame it on everything else as they try to fix it. And if they do manage to fix it, well, they're going to take credit for fixing it, but they'll never accept the blame for causing it in the first place. So anyway, we had the supersized 50 basis point rate cut, and they actually started easing monetary policy earlier than that. They started back in the summer when they announced that they were going to slow down the rate that they are shedding assets from their balance sheet, which is also a deflationary measure. So, really this has been going on since the middle of last summer, even though, price inflation is nowhere near actually defeated, right? After that 50 basis point rate cut, the Fed proceeded to trim rates 2 more times, with the last quarter point reduction happening just last month in December. But at the December meeting, Powell and company threw cold water on the party, indicating that the Fed wasn't going to let the easy money booze flow as quickly as anticipated, right? Powell said the central bank is going to have to be cautious on rate cuts moving forward. And he pointed out, we've been moving sideways on 12-month inflation, kind of acknowledging that, maybe price inflation isn't quite dead yet. And he noted that the Fed has lowered rates a full percentage point since it began easing monetary policy in September. And he went on and he called the current policy stance significantly less restrictive. Now, we can debate whether it's significantly less restrictive or not. Actually, I think the bigger point is it was never terribly restrictive in the first place. When you go and you look at the Chicago Fed's monetary policy indicator that kind of indicates how loose or tight monetary policy is, it's been loose for a long time. Even in the middle of the inflation fight, it was still, on a historical basis, loose. Regardless, Powell says it's significantly less restrictive, and he said we can therefore be more cautious as we consider further adjustments to our policy rate. So basically what Powell is saying here is he's saying, slow your roll. You're not going to get interest rates dropping as fast as you were hoping. And on top of that, the FOMC also slashed its rate cut projections for 2025 in half, with the majority of the committee members only now anticipating 2 rate cuts this year. And initially, back in September, they were predicting that they would cut rates 4 times. So again, cut that projection in half. So why did we have this sudden hawkish turn? Well, it's because, as I've already alluded to, no matter how they try to slice and dice the numbers, price inflation remains sticky. Every CPI measure remains well above the mythical 2% target. core price inflation, which strips out more volatile food and energy prices, it's actually been basically stuck right at 3% since June or July. So not seeing a lot of real positive movement on the price inflation front, at least as measured by CPI. And, as I mentioned, given the inflation data and given the amount of inflation that the central bank created, again, going back to 2008, and especially during the pandemic, you could argue, and I have argued, that the Fed probably should be raising rates right now instead of cutting them. Remember, Paul Volcker, 20%, right? We went to what? 5.5, 5.75, something like that. So, when you put the Fed's war on inflation in that context, it kind of looks like Powell is fighting it with a pea shooter, right? The fact is, the Federal Reserve never did enough to slay price inflation. I'll link to an article on the show notes page. Again, it's at moneymetals.com/news that will kind of show that the inflation fight was pretty tepid, right? The central bank tightened monetary policy just enough to subdue the inflation dragon, kind of knock him unconscious, right? And then they hoped he wouldn't get up off the mat. So now it's gone back to creating inflation, right? Remember the chart from the 70s I mentioned? This is the point that I'm driving at. Inflation wasn't quite dead, and yet they declared victory. They started cutting interest rates, and it would not shock me one bit if we have another surge of price inflation, in the next, I don't know, I don't like putting numbers on things, but in the near future. So, this is important to remember too. By declaring victory over price inflation and then actually easing monetary policy, the Fed has effectively committed to creating more inflation. And I think a lot of people get really confused with this because they conflate price inflation and monetary inflation. It's all just called inflation, right? We have too much inflation. But there's really two different things that we're talking about. So remember this, the precise definition of inflation is an increase in the supply of money and credit, right? That is monetary inflation, and that's really what we should call it. A consequence of this monetary inflation is rising prices. Economy Henry Hazlitt, he's the guy that wrote Economics in One Lesson. If you've never read an economics book, I highly recommend reading Hazlitt's little book. It'll help you understand a lot of things. But Hazlitt summed it up this way. He said, inflation is an increase in the quantity of money and credit. Its chief consequence is soaring prices. Therefore, inflation, if we misuse the term to mean the rising prices themselves, is caused solely by printing more money. For this, the government's monetary policies are entirely responsible. So, boom, there you go. And this is exactly why the government and their court jesters in the mainstream media want to conflate monetary inflation and price inflation. They just want it all to be inflation. And that way, they can blame rising prices on all kinds of different things, Putin's price hikes or, corporate greed or, voodoo, right? Because there's no way to distinguish between monetary inflation, the cause of the rising prices, and price inflation, the rising prices themselves. As Ludwig von Mises put it, the result of this deplorable confusion is that there is no term left to signify the cause of this rise in prices and wages. There is no longer any word available to signify the phenomenon that has been up to now called inflation. As you cannot talk about something that has no name, you cannot fight it. So, bottom line is, the money supply is increasing now. The M2 money supply bottomed a little over a year ago at $20.60 trillion. And since then, it has crept upward. As of October, it was at $21.3 trillion. That was the highest level since December 2022. So even though Powell and company would love to keep easing interest rates because of all of the debt, the maladjustments in the economy, they know that they have to tread softly in order to avoid another spike in price inflation. So, kind of as I mentioned, they're walking this tightrope. And that is their catch-22. So, what about Donald Trump's perspective? Well, he has acknowledged the inflation danger, but he wants lower interest rates now. Last week, Trump emphatically declared that interest rates are too high. Quote, "We are inheriting a very difficult situation from the outgoing administration, and they're trying everything they can to make it more difficult. Inflation is continuing to rage, and interest rates are far too high." That's the catch-22 right there in a nutshell. So it's kind of interesting, if you look back to Trump's first term, Powell and Trump butted heads over interest rates even back then. As the Fed was finally trying to normalize interest rates in 2017, after holding them at zero for nearly a decade after the 2008 financial crisis, Trump frequently criticized Powell and kept urging him not to raise rates but to lower them. And Trump actually got his wish in 2019 after the economy became shaky and the stock market crashed in the fall of 2018. I think this is an interesting lesson right here. Right? We had all of this easy money during the Great Recession. And then finally, they kept it there for, again, nearly a decade. And then finally, the Fed decided, well, maybe we ought to start trying to normalize interest rates now. And when they did, the economy got all wonky. The stock market crashed because the economy is addicted to easy money. So the Fed actually started cutting rates in 2019. Trump wanted deeper cuts. When the Fed only delivered a 25 basis point rate decrease in September of 2019, Trump went after Powell on Twitter, now X, even though the interest rate was only at 2% at the time. He said, quote, "Jay Powell and the Federal Reserve fail again. No guts, no sense, no vision, a terrible communicator." Kind of funny because, Trump is the one that appointed Jerome Powell. But anyway, when you really think about it, if you kind of analyze Trump's psyche as best you can, Trump's affinity for low interest rates is pretty understandable, right? After all, he is a real estate developer, and he recognizes the stimulative value of low interest rates. He knows that when interest rates are lower, it's easier to borrow money and put it into these big construction projects and build buildings and all of the things that Trump does. So Trump just instinctively likes low interest rates. But as we've already seen in the quote, Trump also has to acknowledge the dark side, the inflation. So on one hand, you've got Powell saying, yeah, we're not going to cut rates quite as fast as you might like, kind of trying to be hawkish. On the other hand, you've got Trump saying, I want lower interest rates now. Who's right? Is Powell right? Or is Trump right? Well, the answer is yes. It's a catch-22. They're both right for their own reasons. The problem is you can't simultaneously solve both of the problems. You can't simultaneously hand out easy money in order to keep the economy rolling, to keep the drug addict happy, and on the other hand, keep interest rates higher in order to keep price inflation at bay. This debt-riddled bubble economy, as I've already said, can't keep limping along in this higher interest rate environment. This is precisely why the Fed delivered a rate cut in December while simultaneously jawboning about caution and trying to dampen expectations of more rate cuts in 2025. And then on the other hand, inflation. So here's how Reuters summed up this dilemma. Quote, "Extreme bond market agitation has put the Federal Reserve in a bind. It can either cool long-term inflation fears or acquiesce to President-elect Donald Trump's complaints about interest rates being far too high. It can't do both. So Reuters says that the Fed will likely opt to tackle the former, meaning the inflation, potentially setting up a running verbal battle with the White House over the coming year. Now, the Reuters article mentioned this extreme bond market agitation. What they're talking about is the fact that even though the Fed has cut rates 3 times since September, the long end of the bond yield, so we're talking about 5-year treasuries, 10-year treasuries, 30-year treasuries, the interest rates on those, the yield on those are going up. People are demanding more return, more interest, because they're anticipating more inflation. And I think there's also a sagging demand for U.S. debt, which is also causing interest rates to go up, because I think a lot of people are looking at $37 trillion in debt, rising interest rates, and they're wondering, how solvent is the U.S. really? So the Reuters report goes on to say the Fed has routinely stated that containing inflation expectations is one of its primary roles, and it's, quote, hard to imagine that the central bank will ignore signs of revived price inflation. Now, mainstream people, Reuters, they can say that now, but it becomes easier to imagine when the economy starts to crack under the weight of higher interest rates. And we've already seen that crack, right? I mean, you remember when they first started raising rates, we had the little mini banking crisis. That was purely the result of those escalating interest rates. Now, the Fed managed to paper over that. They stuck their finger in the dam. They created this bailout program. So they bought themselves some time. But that was just kind of a precursor. It was the canary in the coal mine, because we have all of these economic distortions and all of this debt because we've had so much easy money for such a long time. And really, here's the elephant in the room, so to speak. The Fed has already wrecked the economy, again, with well over a decade of easy money. It pumped nearly $9 trillion in new money, and that's inflation, into the economy just through quantitative easing from the onset of the Great Recession through the pandemic. And then that was on top of all of the inflation that it created with, years and years of 0% interest rates. That monetary malfeasance has consequences. It created a massive debt bubble and all kinds of malinvestments in the economy, and the impact hasn't manifested yet. I know I keep repeating myself because I think these are really important points. These are kind of the big picture foundational things that I think a lot of people out there in the mainstream and in the investment world miss. Right? They're focusing on, some of them are just focusing on, the next post on X. But there's a very short timeline, I think, in a lot of investors' heads. They're looking ahead to tomorrow or next week or next month. They're not looking at these bigger picture underlying things that are percolating under the surface. And quite frankly, a lot of them don't have a good enough economic background to really understand all of this. So many of these people were brought up in this Keynesian worldview that stimulus is good and all of that kind of stuff. So quite frankly, they don't get it. Okay? So when the economy visibly cracks, and I think it will, I don't know when, 6 months, 12 months, 18 months. But whenever that happens, whenever it cracks under the weight of these higher interest rates, and this is going to happen even if they lower them some more, the Fed is going to be forced to get even more aggressive in loosening monetary policy. Elevated inflation or not, right? If history is any indication, it will cut rates to zero again, and it will launch more rounds of quantitative easing, and that means even more inflation. That is, I say this all the time, it's the fork they know. It's the path they travel. So, Trump may get his wish, but that would mean that we're all going to be paying a lot more for everything because we're going to see increasingly more and bigger increase in prices. So the bottom line is the Federal Reserve, again, is stuck between a rock and a hard place. They're walking a tightrope. They're in a catch-22, and there is no easy way out. And, this is really important to remember if you're a precious metals investor, if you're interested in gold or silver. This is the kind of underlying things in the economy that you need to understand. Most of the mainstream seems to think that the Fed still has, or not still, but they have inflation under control. Or, at least almost under control. So they are jonesing for rate cuts because they love easy money. They're addicted to it, right? They want that easy money drug back. And it makes sense, right? They're the ones paying the interest on all the debt. So it shouldn't be any surprise that they want lower interest rates because they feel the pain and the squeeze and they know that it's a problem. They know it's not sustainable. But if they can get their hands on some more of that printed money, if the Fed will acquiesce and, turn the spigot back on, put the punch bowl back on the table, well, then the sky's the limit. And of course, this tends to be good for gold. That's why the price goes up generally when there is good news on the inflation front. They think the Fed can keep the rate cuts coming as long as inflation doesn't really rear its ugly head again. And I think that's kind of what they're banking on. They're banking on this continuation of easing and that easy money coming back into the system. On the other hand, people tend to sell gold on bad inflation news, right? So we get information that says, the CPI is creeping up, or, the employment situation is really good, which has somehow become a proxy for inflation. And then they sell gold because they're worried that the Fed is going to keep rates higher for longer. And this makes sense, right? Gold is a non-interest bearing asset. If rates are high, investors are going to opt for assets with a high yield, and they're going to spurn gold. But here's the thing. In the current environment, inflation is the flavor of the day, right? There is either still a lot of inflation in the economy, devaluing your dollar, or the Fed is set to create more inflation, devaluing your dollar. So what's the common theme here? It's your dollar devaluing. So you probably want to have an inflation hedge, something to maintain your wealth as the dollar depreciates. And this is precisely why so many central banks are accumulating gold right now. Speaking of which, after surging to the highest levels of 2024 in October, central bank gold buying continued in earnest in November. Based on the latest data collected by the World Gold Council, central banks added a net of 53 tons of gold to their holdings in November, and that pushed official central bank gold buying to 807 tons for the year. And that's on the heels of a record third quarter. So a World Gold Council analyst said that the continued increase of central bank gold reserves in November, quote, extends a broader trend we saw throughout 2024, quote, driven by the need for a stable and secure asset amid global economic uncertainties. In other words, devaluing dollars coupled with the U.S.'s weaponization of the greenback. Those are the global economic uncertainties. So, when you look at these official gold numbers, too, it's likely that central banks have added even more unreported gold. For instance, the People's Bank of China quietly purchased over 100 tons of gold in October and November. I'll link to an article in the show notes page that kind of covers that in a little more detail. And, speaking of the Chinese central bank, it publicly returned to the table, officially adding gold reserves or adding gold to its reserves after a 6-month pause. It had a 5-ton official increase in November, followed by another 10 tons last month in December. And, China was the biggest central bank gold buyer in 2023, but it stopped announcing increases to its reserves in May. And I say all of this just to kind of underscore the fact that, while investors in the U.S. are trying to figure out what the Fed is doing and selling gold every time they think that they're not going to get the rate cuts that they're wanting, China is relentlessly buying gold. And they're even buying gold with gold at record prices because they recognize the problem with the devaluing dollar. And of course, they felt the sting of the weaponization of the dollar. So gold, it is an inflation hedge. It is a safe haven, and it is real money. And when the fake money is depreciating, you might want to hold on to some real money. So, it might be a good time to follow the example of the central banks and add gold and silver to your portfolio. If that is something that interests you, I highly recommend calling Money Metals at 800-800-1865. Talk to a precious metal specialist, and they can help you kind of figure out, how can gold and silver fit into my investment strategy? How can I preserve my wealth with precious metals? What should I buy? They can help you answer all of those questions. If you don't like talking to people on the phone, I get that. You can go to moneymetals.com. You can chat with a precious metals specialist in online chat, or you don't have to talk to anybody. You can just go to moneymetals.com and you can purchase all of our gold and silver products right there online. And the thing is, you want to do it today because, as I've explained, you're not going to see, your value or your dollar stop devaluing. Devaluing is what is going on. So make that call today. And with that, we're going to call it a wrap for this episode of the Money Metals Midweek Memo. You can get more information about everything I've talked about on the show today, and a lot more, of course, over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your email inbox, make sure you sign up and get on our email list. Of course, you can subscribe to the Midweek Memo on your favorite podcasting platform. And when you do that, you'll also be able to tune into our Market Wrap podcast every single Friday, where you'll get a quick overview of the week in precious metals, along with conversations between yours truly and interesting people from the world of gold, silver, economics, and investing. So, as I always say at the end of the show, I really appreciate the fact that you've taken time out of your day to listen. I know there's a lot of stuff to listen to out there. Thank you for spending a little bit of time with me. I hope you have a fantastic rest of your week, and I'll be back here again next Wednesday.